Let's take it across to Rahul Bhasin and find out which way the market is headed next. Rahul, hi, good morning. What's happening here, Rahul? Less than a month, you've got $200 billion wiped out, and it doesn't seem like the pain is anywhere far from over. What can the government do? I know what they've done, which has escalated this sell-off in the market, which is the taxation and FPIs. But what can they do? Will it have to be a clear rollback? Out and out, and will that make these outflows stop?
Look, I think one of the big challenges is that we probably, there are two kinds of issues to my mind. There's one is a liquidity issue, and I think that if you look the last 3-4 years on the back of very important structural reforms which are needed in the economy, actually have resulted in monetary velocity being destroyed. So the M1 to M3 transmission has impeded it. The fact that 70% of your banking system, the public sector banks, essentially had their capital wiped out and therefore could not transmit, which meant that every time you gave them money back, they could not re-lend it. I think the combination of the reforms plus the overhang of the banking system woes, the public sector especially, I think the combination has led to a very sharp liquidity crisis. I think the other big issue which is harming and hurting the markets is the fact that I think that we have moved in terms of policy balance maybe a little bit too much to the left, so the social justice expenditure has gone up considerably. I think all governments have a choice of whether to invest in making sure that the people who generate income and wealth are incented to keep doing that and to keep growing, or to take part of that money and to start spending it on equity. And I think that that's always a very sharp choice that governments need to make, and that's in a poor country like ours, that's always a difficult choice that people need to make. When I think that we have swung too far to the left, the consequence of that is that it is now impeding investments, growth, reinvestments, capex is getting impeded. I mean, one can talk about having intentions to lower corporate tax rates to make it akin to what's happening around the world. If we look at Southeast Asia or other parts of the world, corporate tax rates are much lower than where we have them now. But you lower corporate tax rates at one side, add on, instead of that you have dividend distribution tax, and then you have buyback tax introduced. Effectively, you've done the same thing again. You've actually raised taxes, not lowered them. And I think it's very sad, because if you look at it, foreign firms are not coming in, they're not integrating India into their global supply chains. And in an environment where the world wants to diversify away from China, I think we are missing out on a massive opportunity here. I think that some of these kinds of forms of taxation, to my mind, are retrograde. I mean, if a company can't utilize its capital efficiently, wants to return the money to shareholders who then want to redeploy it somewhere else, if you start taxing that movement or mobility of capital, I think you're damaging the economy. And I think these kinds of movements have actually hurt and damaged the economy. And I think that incrementally, first you did it with dividends, but there was always the opportunity to redeploy capital through buybacks. Now you have even put a tax on that. I think that this is the government will have to do something about correcting this balance. It's gone a little bit too much to one side, and it will have to do something serious about the liquidity. And to my mind, our interest rates have been too high. That has knocked the bottom off a lot of real assets in the market. A lot of lending in the markets to SMEs, to smaller companies, have happened historically in India on the back of and on the comfort of assets like real estate, office space, etc., which gave comfort to the banks. The fact that there is no market clearing in a lot of those assets is again impeding monetary velocity, according to me. So a sharp interest rate cut, a whole host of measures required to in fact increase the M1 to M3 transmission, plus correcting a little bit on the fiscal side. And I think a strong initiative by the government to try and ensure that we get on to global supply chains. I mean, I think that you need a combination of these things, and you need them urgently, according to me. I think just mere tinkering will not solve this problem.
Seems like you're asking for a lot at this juncture, going by the kind of mood that the government is in. But Rahul, aside of that, if this were not to happen, do you think it's tough at this juncture for the animal spirits to return back to equity markets?
Look, like I said, I mean, if you look at it, you've introduced capital gains tax, you have buyback tax, you have dividend distribution tax. Then after, you also have tax on distribution in the hands of people receiving it. I'm just saying that the entire ecosystem and environment is actually impeding investments, and we just have to squarely face that fact. You've gone down a route which of equity, and equity is good, but there's plenty of evidence that if you increase the marginal rate of tax, direct and indirect, over 50% of what a person earns, it starts impeding investments, and we are seeing that. I mean, there is empirical evidence around the world on this, but it's very sad that and we've learned these lessons before in India, and we've made these corrections, but it's very sad that as the bureaucracy kind of retires and moves ahead, we get a new lot who again repeat the same mistakes. I mean, it's rather unfortunate.
What does an investor do at this point? I mean, you've been very direct with your views, and I agree, it's not a pretty picture at this point with regards to the economy, the slowdown, liquidity, or from the equity market standpoint. What would you advise investors to do currently? Would you be looking for value at lower levels? Would you be risk averse given the current scenario and the uncertainty, whether it be domestic or global?
Look, I happen to be in a fortunate industry where I can take a long-term view, and the way I look at it is that very small percentage of our economy or our population, I think less than 20%, it's 18 to 20%, actually are in what I call a normalized consumption pattern, which means that there is plenty of runway for the rest of the economy to catch up as far as that is concerned. I do believe that these kind of these kinds of policy aberrations happen. Like I said, there's always a conflict in a poor country to do social justice versus actually incent people to grow incomes more so that they can provide revenue and resources to the government. And I think that these balances will be corrected now. I don't sense urgency in the government or the bureaucracy at this moment to do it. So I wouldn't make a bet that this is going to happen in the next 6 months or 9 months. But I'm pretty sure that it will happen. I mean, there is enough intelligence and enough sort of economists around within the government ecosystem that they will make these corrections. So if I look beyond a lot of the pain in the short term, I would definitely stick to investing in equity. I also think that now the mid caps and small caps have gotten bashed down so much. I think there is probably decent opportunity there. I think besides this,
Rahul, let me just butt in. Would you re-look at your sort of outlook on returns from equities, however, even if you are looking at the overall long-term picture, just to get your perspective, whether it be a year down the line or, because we've already slipped into negative returns now for 2019, not faring all that great even versus our peers in emerging markets currently. So that confidence even on flows with regards to whether the FPI tax or regards to where we are currently in terms of valuations, none of that's really driving any kind of any kind of action in the equity market. So would you be re-looking at the kind of returns possibly we could expect?
So look, we are focused much more on what I call the disruptive part of the economy at this moment, which is not that impacted by these policies. I think it's more impacted by technology changes and by business model innovation. And the reality is that when you have an adverse environment for investments from a cyclicality perspective, it narrows the scope of investments and investment opportunities significantly. But it's a large country. I mean, for an individual fund, it's easy. It becomes much harder for the individual retail investor to be able to access, this kind of opportunity set. But I think that there is very serious structural changes taking place in businesses around the world. I think one needs to look at the fact that 50% of the market cap of the Dow now is accounted for by 6 companies. I mean, whether it's Amazon, Facebook, Google, Netflix. I mean, it's this technology-driven part of the world which is actually dominating,
Yes.
where the consensus view around the world is that the net present value of earnings is going to head there. So I think there are a lot of these newer businesses.
But Rahul, how
which are
long
going to
term
create
are
value.
we, just to add to that, like how long term are you really talking then? Because again, just for the sake of argument, and I know there's a clear strategy here, but we've also been in conversation with the Amazons of the world here in India, and it seems to be a very long-term trajectory riddled with regulatory hurdles, a lot of capital investment, and frankly, if we're talking about consumption slowing down, how are they actually going to manage to show any kind of path to profitability?
I apologize, the line is not very great, so I'm not very certain I got what you said, but I'm going to sort of guess a little bit. I think
Sure.
that you're probably asking me about path to profitability of these businesses and the term that it will take to actually play out. Have I understood you correctly?
More or less.
Hello?
Yes, go ahead, Rahul. Absolutely. I mean, while a lot
I
of
apologize, but
no problem. While a lot of
Yeah.
investment is flowing into that pocket of the
look,
market.
I do believe.
Go ahead. Go ahead.
Yeah. I do believe that there is ample opportunity in the disruptive part of the economy for people like ourselves and our businesses. But in terms of the cyclical, return in the markets, I think sadly it's not months, but it'll be, it'll be more like years where that will play out. But it will play out quite sharply because whenever demand gets repressed in India, it always bounces back very sharply. I mean, if you've seen slowdowns in the past, when two-wheelers and four-wheelers stop selling, it takes a while for it to come back, but when it comes back with 30-40% kind of growth. I think in the auto sector, one needs to also worry about this entire EV and the transformation, whether it's to BS6 and EV. I think that changeover is probably impeding some amount of the sales currently too. So there is this, what I called technology structured impediments which are taking place in the short term. Those will get overcome rather faster, according to me. And if you look at talent, opportunity set, etc., I think I am kind of optimistic that we will find a way around it. But there does need to be serious policy corrections, whether on the monetary side and on the fiscal side. I think both of these are imperative and they're required and they're urgent.
Much for joining us this morning. Great to get your perspective and appreciate the frank, outlook that you've shared with us this morning. Good chatting with you.